Housing market, the tide may be turning from a seller's market to a buyer's market as home value growth is slowing from record highs. In a recent survey of more than 100 housing market economists, Zillow asked which year might decisively turn into a buyer's market, and more than half of the economists said sometime next year. About a quarter said 2024, with the rest tracking a buyer's market in 2025 or later. Senior Zillow economist Jeff Tucker says people surveyed also anticipated decline in home prices in coastal markets like the Bay Area.
Another one of the major results was just asking which types of regions, which parts of the country are most likely to see substantial declines in home prices. And right up there near the top of the list was expensive coastal cities such as the Bay Area.
All right, experts say while high mortgage and interest rates have sidelined many potential home buyers, they do not see those variables dropping dramatically anytime soon. But of course, not all experts agree.
No. So for more on this, we want to bring in an expert of our own, Morgan Stanley financial advisor, George Nocetti. Boy, how quickly things can change. So you're saying no more competitive bidding on a house in the Bay Area anymore?
Well, it was so frothy, January for a couple of months there. I mean, extremely frothy. House prices were, bidders were bidding 50,000, 100,000 over the asking price. That's all changed. The lending rates now have been incredibly expensive. Just a few months ago, it was 2 to 3%. Now we just hit a new median high of 6.7%. That's an extremely high rate. So anybody who's borrowing has to have that as paying their interest, and then they have their principal, and then they have their property taxes, and you keep adding it all up. It's pretty expensive. And so, bankers look at, do they have the income to support the debt? And as these rates get doubled from what they were previously, a lot of people are just priced out of the market. Prices are going down. People should get their balance sheets organized, try to reduce other debt that they have so they can enter the market at the appropriate time for them.
What say you? When's the best time to buy? I know it's hard to predict, but would you say 2023, now, beyond 23?
Well, Grant, I'm going to take you back to the future, back to 1981. I mean, the interest rates for mortgages were, 19%. Can you believe that?
Oh, yeah.
It hit an extreme high. And, well, Vicki, you're too young. But anyway, it hit an extreme high.
Thanks, George.
And so as a result of that, the bank started, pulling back. And so some people actually financed mortgages at the 18, 15% rate because they had the means to do that with the idea that the rates were going to hit a peak and then they could refinance a year or two later. Same principle applies. If you have the means and you take on a high rate because you're seeing home prices come down with the idea that you may be able to refinance a year or two when the mortgage rates drop, that might be a strategy for you. But, so many other people have really priced out of the market. I mean, even these tract houses that are being built, the developers of these tract houses have been slow playing it. Their permits have cost them more. Their lumber material price have cost more. Their labor has cost more. So the prices of these houses, the material costs have gone up. Their margins are less. So they're really slow playing it, not finishing some of these projects because there really aren't the buyers who can really have the correct, debt to income ratio to get that loan at the bank because the rates are so high right now. Now, the rates aren't going to stop for a while because the Federal Reserve is going to continue with a heavy, heavy hand, raising the rates that they lend banks to money. And you know what? That's the only tool they have. It's a sledgehammer. And when they use that sledgehammer, there's going to be some carnage. People are going to get hurt. But it's one of the only things that they can really do to help get people from buying at these extreme rates and get the interest rates down and inflation down. So that's their goal, and they would see success if people stop buying for a while.
So there are opportunities, though, because frankly, prices of homes, even the median price, is just ridiculous. What, $800,000, $1 million? Who would have thought that, 10 years, 20 years ago? Right. So, granted, you could get it, when mortgage rates were 3% or whatnot, it could get you into the market. But isn't there some room for the prices to adjust? It seems like, the prices have to come down at some point, too.
Well, no. Right now, the prices are going down. But as the prices are going down, the mortgage rates that you're going to have to pay are going to go up. So even though you might finance less money, the percentage cost is much higher, and that's carving a lot of people out of the market.
Sure.
So there is still great demand, not as much competition. prices are going down. So if you have the means and you can afford the 6%, mortgage, with the idea that perhaps later on, if the mortgages come back down, you can refinance. I mean, that would be a strategy. Other people who are priced out right now, what they should be doing really is, reduce their spending, try to get more savings for a down payment, reduce their debt. If they have college debt, pay it down. If they have credit card debt, get rid of that, because those are all the things that banks look at when they look at your income to debt ratios. So it's it's going to be hard. And a lot of people are going to be priced out of the market for a while until we get the interest rates down.
So, George, you did mention back in '81 where a mortgage rate was 19%. We're not moving in that direction again. I mean, if you're hoping to wait it out for the rates to come down, you think they'll ever be as low as they were?
No, I don't think we're heading towards a 19% rate at all. I mean, fast forward to today, think about it. I mean, we have very low unemployment. It could go up a little bit. It's still low unemployment.
Right.
We are energy independent in this country.
George, we're out
people
of
are
time.
working. Yeah.
But I want to get this in real quick. What's with the gas
sir.
prices? Why are we paying so much? We always pay more, but why is it so extreme right now, California versus other states?
Quickly, prices are a commodity and they're manipulated. Suppliers, in Saudi Arabia, even in the United States, are energy independent. We can manipulate price. And then in California, you can add on $1.50. Whatever you're seeing, take $1.50 off for taxes. And so other states don't have taxes as high. That's why you're seeing a much lower rate.
Yeah, it seems like there's always some reason. Whether it's
there's a price to pay to live in California. It's a beautiful place. It's expensive to live in.
All right.
Fair enough.
Good information. We may not like to hear everything you're saying, but thanks for informing us.
Don't shoot the messenger, please.
Exactly. All right.
Don't worry.
Okay.
Yeah.
Morgan
Thanks,
Stanley's
Vicki. Thanks,
George
Grant.
Nocetti. Thank you, George.
Thank you. Have a good evening.